Hello, everyone. This is Paul Damon, President of Family Capital Management. Welcome to our fourth quarter 2017 market review. It's been another interesting quarter in what appears to be a very interesting year with a lot of things happening in the markets. The first thing we're going to look at here is the market. On the left, the chart shows the market since 1997, the S&P 500, all the way through the third quarter 2017, shows the last two market cycles in the S&P 500, highlighting the peak and trough valuations, so as well as the index levels, dividend yields, and the 10-year Treasury. So you see in the chart in the middle, in the box on the chart in the middle, towards the top, you see the information about the index, the PE ratios, dividend yields. So things continue to move in an upward direction overall with some volatility, as normally happens. It's quite a mountaintop and valley experience, but we've had, since the bottom in 2009, the market has had a strong upward trend, again with a couple spikes downward, but overall generally an upward trend. This chart shows the valuation metrics for the S&P 500. In the top right box, you see how the market has measured the PE ratio. Most recently was 17.7. The long-term average is 16. And so the market on that measure alone is slightly, what they say, above average fair value. So stocks are mostly priced on earnings, but a lot of factors impact stock market price fluctuations, which we won't go into all that today, but earnings is one of the key measures of where the market is today compared to the long-term trend line. So again, the average being 16 times earnings and the current level of about 17.7 times earnings. This chart shows on the left the corporate profits for the S&P 500, and there was a little drop last quarter, which there's speculation and discussion as to why. Many things could be impacting that last quarter, but most analysts talk about transitory factors, and now that's improved. And so earnings now, this last quarter, again, were better than the previous quarter and higher than the quarter before that. So now, again, the trend line is on an upward trajectory, which, again, as we mentioned before, generally means stock prices have moved in an upward direction corresponding with earnings. The chart on the right shows two facts that have historically been headwinds to earnings, which is the strength of the US dollar and weakness in energy earnings from the effect of low oil prices. Headwinds from the stronger dollar have dissipated this year, and so as the dollar has weakened, that's helped U.S. Corporate profits and sales over the international markets. And it appears that a majority of the write-downs in the energy industry are behind us, and so there's a slightly upward trend in oil earnings, and that's projected to increase or continue to increase. The slide here shows returns and valuations by investment style in the U.S. equity market, and it leverages the style box framework that was pioneered by Morningstar. So return periods include the most recent quarter, year-to-date returns, returns since 2007 peak, and returns since the 2009 low in the market. To the right, the valuations depict which areas of the U.S. equity markets are trading at a deeper discount or premium relative to their own 15-year average. So, for example, the current PE versus the 15-year average, large company stocks are trading, large company value stocks are trading a little bit lower than the average, but large company growth stocks are trending a little bit higher than the long-term average. Large growth stocks have been driven by some key leaders such as Google, Amazon, Netflix, Facebook, companies like that. The stock prices have really shown dramatic increase over previous periods, and so we'll continue to watch that. Who knows how long that run will actually go, but certainly it comes with a fair amount of peril with it as well. This slide, number 11, shows the intra-year lows in the stock market, which is the red dot and the number associated with it. And then it shows the year-end return for the full year for the S&P 500. And what is clear is that the market is capable of recovering from intra-year drops and finishing the year in positive territory, which should encourage investors to stay the course when markets are choppy. In fact, in almost every year, at some point, the market is down from where it was at the beginning of the year, and yet in most cases, or in many cases, the market ended up finishing up for the year. So it's, again, an indication that volatility will happen and will be part of what it means to invest, but to stay the course and to not panic is usually the best course of action. Next slide, number 12, the chart on the top left shows corporations have amassed large amounts of cash reserves relative to current assets, which is, again, another possible boost for the economy and possibly stock markets, because that cash at some point could be used to either pay dividends, buy other companies, or invest in growing their own company. So cash is an important feature or function of corporate operations, and certainly it gives them opportunities to do lots of things. The chart on the top right illustrates how share buyback activity and dividends per share have been increasing. So both since 2009 have shown fairly significant increase in dividends per share, as well as share buybacks. That's companies buying their own stock back, which is, again, generally a positive indicator for the markets, because it shows that corporations feel their own stock is undervalued. So they'll take some of that cash that we mentioned and they'll buy their own stock. The chart on the bottom left shows that corporate debt relative to the GDP is increasing. And so that, could be interpreted a number of different ways, but certainly something to keep an eye on. The chart on the bottom right shows that capital expenditures and merger and acquisition activity have significantly picked up. So again, companies, businesses are investing more in capital equipment, and they're also buying other companies. In many cases, they buy competitors, or they buy companies that they feel can be a strategic alliance and can help grow their own business. This chart, number 13 here, shows the historical bear markets, and that is when a market declines 20% from the previous all-time high and what caused them to happen. The magnitude of the drawdown is also illustrated. And this is meant to illustrate that lofty valuations are not predictors of bear markets, but that bear markets are caused by external factors such as geopolitical conflict, monetary policy such as Federal Reserve raising interest rates or tightening credit, so action of that nature, and then recessions. So the majority of the drawdowns are impacted by those types of activities, more so than just a pure look at stock valuations compared to long-term averages. Chart 15 here shows the S&P Composite Index over a long period of time since 1900. And the log scale helps illustrate how long-term index patterns, namely the distinct periods of range and trend-bound markets, have impacted the market over time. The annotations help to indicate what caused movements in the market. So you generally see the market moves for a period in more of a sideways with some volatility trend. So this is 1900 to 1925 roughly. The market didn't move upward, it moved mostly sideways. Then the roaring 20s period, we saw the big breakout in the market, followed by the Great Depression, the recovery, a sideways movement for about 10 or 12 years. And then after the war was over, the boom in from the 50s to 1970, which is kind of the baby boomer generation, was born. And the Vietnam years where the market moved sideways. After that, the boom from the 80s to 2000. So you kind of see the sideways, up, down, sideways, up, sideways, up, sideways, and again with a lot of volatility, but markets generally go through these cycles. The next slide here, number 18, shows the impact of the amount of assets on the balance sheet for consumers, and certainly homes, a big part, and then other financial assets, which is stocks and bonds and investments, pension funds, and then that's compared to the liabilities. So when you total up all the assets for consumers in America, it's $111 trillion, and the total liabilities are about $15 trillion. So while our debt as a nation and as consumers' debt is talked about frequently and is a concern, consumer debt is actually at a relatively low point, and that's also illustrated on the right-hand side with the debt service ratio. So the amount of income on average needed to cover the debt that consumers has is a little bit less than 10%, which hasn't happened since about 1980. So the picture for consumer debt is actually fairly positive. Slide 30 shows the historical and projected balance sheet of the Federal Reserve. The chart is annotated to show how the balance sheet has evolved over time, including the beginning and ending of 3 quantitative easing projects. The forecasted reduction is based on Fed commentary and should help us to guide investors towards what the balance sheet may look like in the future. So right now, the Fed holds a lot of assets on their balance sheet, as you maybe have heard about. The MBS notation there, the kind of dark purple, and then treasuries, another large allocation of about $2 trillion, and then the other portion. So the total balance sheet is about $4.5 trillion, and the forecast for the Fed and the discussion that they've indicated is they're going to reduce that over time, get those assets off their balance sheet and get them back into the marketplace, which many people think could lead to higher interest rates. So something we'll certainly keep an eye on and want to be mindful of as we work with our clients and portfolios. Slide 37 is the fixed income sector returns. It highlights the importance of the balance sheet and diversification within a specific asset class, in this case, fixed income. The asset allocation portfolio is rebalanced annually and contains each of the fixed income sectors as shown on the chart. So for this year, a diversified portfolio of bonds is up about 4.7%. And so if your bond portfolio with us should reflect, based on your allocation, what you see there, the best yielding is high yield bonds, up 17%. The worst performing, I'm sorry, that was last year, 17%. The worst performing was municipal bonds, slightly negative. This year, year to date, the allocation, the best performing is emerging market, denominated in foreign currency, and the worst performing is Treasury inflation protected, which is called TIPS. And finally, for U.S. stock market, last year, again, we saw an average of 8.3% for a diversified portfolio. This year, the year-to-date average for an asset allocation blend of about 10.6%. So this indicates that staying diversified, you're going to average out some of the highs and lows. You're going to avoid the extreme volatility, hopefully, of being in one or two asset classes. So we are, as you know, big believers in diversification and want to make sure that our clients' asset allocation, their portfolio, is diversified and has exposure to as many asset classes as it makes sense to generate the return that you need to achieve your goals, and with the volatility that you're able to handle from a emotional standpoint. So that's the conversation we wanted to have with you today. Thank you so much for taking the time to listen, and hopefully this has been a helpful update for you, and we will speak to you again soon. If not, we